day, and thank you for joining us on Money Smart Week, while we take you guys through the Know Your Cash campaign offered by Financial Care Corporation and solely sponsored by SAIA. Today, you'll be joined with Nikki Motiba, one of the guys at Financial Care Corporation, who will be taking us through all the content that Know Your Cash has to offer. Basically, before I even get started, I think it's important that you guys actually know what Know Your Cash campaign is really about. So it is a consumer education initiative. It's focusing on insurance, financial literacy, specifically targeted to young adults in South Africa. The campaign was launched in January 2019, so it's already now in its third 10 year. And as mentioned, it is an initiative which is powered by Financial Care Corporation and solely sponsored by SAIA. So what really inspired us to launch this type of initiative?
Yeah.
Well, at FCC, we're passionate about packaging holistic and financial wellness services, and one can't help but notice really the real lack of insurance and financial literacy knowledge, which I'm sure
especially within our South African young adults, the youth, the school leavers. You're quite right.
Yeah, I mean, you look at the statistics of debt management in South Africa, how many consumers are over indebted, how many people are uninsured in South Africa, and the lack of really proper retirement planning of South Africans. It's something like around 8% of South Africans can actually retire, and that doesn't mean retire well. It just means actually retire. So that, there's a huge gap in the market, and that's where we really saw there's opportunity to have such a campaign that can really help all South Africans from all different walks of life. So in today's session, we're going to be going through the different topics that are offered through Know Your Cash in 2021. And these are made up of budgeting, saving and investments, understanding the importance of non-life insurance. Okay,
that's very important.
Extremely important. And then also looking at budgeting and engaging with the financial sector.
Lovely. I think we should also throw in the consumer behavior.
Okay, we can go through that.
Yeah.
All right, perfect. So what really is budgeting? So budgeting is the process of creating a plan to spend your money, and the spending plan is called a budget.
Yeah.
When we look at creating the spending plan, it allows us to really determine in advance whether you'll have enough money to do things that you need to do, that you would like to do, pretty much. I mean, that's what it is in a nutshell. And it's really now about balancing your expenses with your income. So pretty much itemizing all your expenses, physically actually drawing up, as primitive as that may sound, but actually physically drawing up a table which takes you through all your different list of expenses.
So here I am, take a page, here's my income. Obviously now my income, Nathan, is just one income.
Yeah.
It's 100 rand that comes in.
Yeah.
Ask me about my expenses now. It's going to be a list of a whole lot of other things that I do. Do you have to write all of them down, though?
Well, essentially, you break them up. So you look at what is your fixed expenses. So as an example, obviously your rent or your mortgage payment, right? That's not going to change too much. Well, it has been changing over 2020 with the interest rates fluctuating, which has been favorable for us, obviously. Yeah. But generally, that is your type of your fixed expense, your car installment. You can also get a gauge of whether you're renting or whether you own a house, or what your electricity and your rates and taxes are.
True.
So you can gauge that. Obviously, different months of the year will fluctuate, but essentially you get a bearing of what your fixed expenses are. Of course, then you're also going to have miscellaneous expenses. Yeah. So, I mean, what is a miscellaneous expense? So you're living in a house, there's a heavy rainfall like we've been having recently, and there's a major leak that's appeared in the roof in the next second.
And you didn't really plan for it. It's something that you hardly ever planned for.
Yeah. So it's important to provision some kind of a. I'm going to stay away from savings because that's its own topic, but to at least have some kind of a provision towards your miscellaneous expenses. So actually, and the only way that works is by putting that in your budget. So saying, I'm going to put aside 500 rand specifically towards miscellaneous expenses, so that it doesn't compromise your whole plan that you've put in place from whenever it's been. Because that's what throws a lot of people off with budgeting is they start so well, they get into this nice routine, and then 3-4 months down the line, one of these miscellaneous expenses comes along, and it just totally destroys everything, and then people literally give up on the whole budgeting exercise, and they think, well, it's not working. So it's important really to put those principles in place from the get-go.
From the get-go.
So that you don't get caught, by surprise.
I've seen. I think when I was still a bit younger, I used to spend a lot on food.
Yeah.
And transport without me really noticing. And I'll tell you why on food. The days when I was lazy to cook or to prepare a simple meal, like your instant soft porridge, for argument's sake, I would feel like eating a full breakfast with bacon and all of that and a dessert. But then I realized that I was spending so much money on food, but it really helped me to write down how much I was spending. So each and every portion of my cent that I spend, I used to write it down. I didn't know how to budget in advance.
Yeah.
But what I did was I wrote down my expenses, and then end of the week or end of the month, I would look at where did I spend more.
Yeah.
Then I realized it was on transport and food, but then lately I realized I spend more money again on data.
Okay.
Because I'm live streaming, I enjoy listening to music.
Yeah.
But I don't realize that I'm not really investing in myself. So those are some of the expenses as well that can, as you were saying, throw you off.
Yeah. No, 100%. So yeah, I mean, it's really now about having that plan in place and following through with it. And like we mentioned from the get-go, and with Know Your Cash, it's all about creating that culture and that routine. And that's exactly what a budget is about. It's about having it throughout your everyday life.
Yeah.
Always on your mind. Well, frequently on your mind, that you're at least reviewing it once a month, let's say, and making sure that you are pretty much in line with it as much as you can be.
But it's difficult, Nathan. Let's admit. As much as we can say, as we speak about it now, you assume it's a simple process. Like I said, I started the reverse way. Instead of planning on where I didn't tell my money where to go to. I observed first. Yes. Where is my money going to? Okay. Where is the wastage? Where am I not saving? Not necessarily with the bank, but where am I not trimming the extra fed? Then step by step, I started eliminating all those other expenses that are too unnecessary. Once in a while, I'll go to a restaurant. But again, by the time you get to the restaurant, you wanted to go and eat breakfast or just a simple lunch. And then the waiter comes through with a menu that shows lamb shank. And you decide, I haven't had lamb shank for years.
Yeah.
And the budget, it's not in your budget. Is that what you're saying? If it's not in your budget, try by all means to avoid it.
Yeah. No, 100%. And just before we move on to the next topic, something very important I wanted to mention as well was how, when you structure a budget, creating and having the priorities first, obviously.
Yeah.
So what are my priorities? Well, obviously it's housing, it's transport, it's education, it's food.
Yeah.
But there's one other really important topic I'd like to mention, which is about having provision for insurance.
Yes.
So make that a priority. And why do I say make it a priority? So that you can have enough to afford the necessary covers that you need, that you really need. Instead of kind of creating this budget and leaving insurance last, where maybe there's not much to play with, and then compromising yourself by getting something that's not necessarily what you need. So our next topic we're going to go into now is consumer buying behavior.
My favorite.
Well then, please be my guest, and let's go.
I'll tell you why, Nathan. You remember when I said to you, the way I started using my budgeting skills reverse. It's simply because I looked at the way I budget and I thought, okay, Nikki, here you are budgeting, but you're budgeting the wrong way. Look at what's wrong. It all boils down to one thing, Nathan. Behavior. My spending pattern. Psychologists say it's a process that you use to take decision on what to purchase. And it can be too extreme sometimes. They summarize it as 3 points. There's planned behavior or planned buying behavior. That's where you do exactly what you were saying. I budget, I look at my income, I look at my expenses, and I stick to exactly what the priorities are. End of the month, you might find that there's discrepancy here and there, but it's not that huge. You don't necessarily regret,
But
And
tell
then-
me, sorry, Nikki, tell
Yeah.
me, when we look at consumer buying behavior, what really are the three main planned or the buying behaviors that we mostly encounter in our everyday lives?
Like I was saying, looking at the planned one, it's the normal behavior, for people who are relatively more disciplined.
Okay.
And then you have your impulsive
Right,
buying
right,
behavior,
okay.
and you have the other one can be too extreme. I'll get to it now. The planned one is exactly what I was saying. You plan accordingly, you behave accordingly. Impulsive is you going past a shop, for argument's sake, and then it's written sale 50%.
Yeah.
You did not plan for those
Right.
sneakers. You wanted to buy a golf shirt. You wanted to buy a beautiful pen just so that you can go and write your exam.
Right.
But guess what? You end up buying other things which do not necessarily even complement exactly that which you were going to buy.
Yes, yes,
So
yes.
that's more of your planned behavior. And the consequences of both of them are different. With the planned behavior, you don't regret much. With your impulsive behavior, you end up being at a point where you regret the things that you've bought, and you might find that it's too late to return them to the shops.
Right,
And then
right.
the spiral effect is your debt, as you're saying. You end up being engaged in a lot of debt simply because you did not plan properly. That's
Right.
impulsive buying behavior.
Right.
And then you have the compulsive one, which is the extreme one. Compulsive behavior purely is for people who are addicted.
Okay.
Think of somebody who eats a lot when they are depressed.
Right, right,
People who shop a lot when they are depressed.
right.
So it's escapism. So you're escaping
Okay,
from your
okay.
troubles or whatever that you're supposed to face.
Okay.
This morning I was reading about something. They say, face it until you make it, not fake it until you make it.
Okay, okay. That's-
So with that one as well, with the last behavior, I'm saying to you, face it. Don't go saying, I want to show the Joneses what I have. If I bought a Polo and you want to buy a Mercedes Benz, all of a sudden I want to buy a Mercedes Benz simply because people are giving you attention. And then you end up buying things just to please people or just to make yourself too happy, and you do not need. The consequences, again, you
Okay,
go
so, yeah.
slowly and slowly into depression. And usually we end up recommending that people should go and see a psychologist.
Okay.
So just be aware of those three behaviors. You plan properly or you are too impulsive, just like that.
I think as well, another important point before we move on
Yeah.
is try and understand and look at your routine when you do shop and analyze and see, do you really go and do an information search? For instance, if you go into the supermarket, you have an intention to buy dishwashing liquid. Have you done a search to say, okay, well, at this time of the month, or there's a certain special that's running on a quality of dishwashing liquid that you would like to purchase, or have you just simply gone randomly just purchase it because you need it? So look at practicing these principles of consumer buying behavior. It does get quite technical, but like Nikki was saying, if you can get your consumer buying behavior correct or on track, it will tie in beautifully with having a proper spending and budgeting plan in place that will actually work.
Always be aware. I think that's the message. Always be aware of your buying behavior. And the degrees, they differ.
Yeah.
I think we'll go to another.
Yeah, so we're going to now move on. We're going to move on to something which is what I would say more of a positive type of topic, something that everyone is normally interested in, which is savings and investments. Why I say that's positive? Because it's really about looking ahead of time and planning for a brighter future. You know, it's important really to build a good attitude towards saving and investing as young as possible, should I say. I'll give you a prime example. So when we look at retirement planning, okay, where people go wrong is they think I can start when I'm in a good position in my job. Let's say 30 plus, right? When I'm more secure in my career. Okay, I've finished my studies, I'm comfortable with my job now. Now's the time to start saving towards retirement. Okay, but one doesn't realize that the longer you leave it, the harder the task is obviously to get to that goal, which is why South Africans struggle a little bit to reach that goal. And what do I mean by that? So let's say I start at 20, you start at 30, right? Our retirement goals are the same. So we both want to retire with a certain amount of money at 65. Okay?
Yeah.
I'm not even going to, you can retire at 55 with the retirement schemes. You are allowed to withdraw at 55, but let's be honest, who can really retire at 55? So let's
Have to go the whole 9
let's
years.
keep it at 65,
Yeah.
right? So my intention is I'm going to retire at 65 with this amount of money, and you've got the same goal, all right? But you started at 30, I've started at 20. Suddenly your savings provision that you have to have is much higher than mine, because obviously I've started prior. So I've already built up a lump sum. And that's where people get caught up, because they almost feel like, geez, in order for me to attain my goal, I'm going to have to put aside so much, it's impossible. Let me just leave it. Let me completely leave it out the way. And just
their
build my
behavior
own
says-
savings and, whatever, invest into other vehicles, okay? Because there is obviously a market for
Yeah.
different types of investments. But people, yes, they do ignore that, and it creates this bad cycle, which we have now. So once again, it's about creating that level of routine in your life. So even if maybe at this point in time you can't afford to save as much as the retirement calculator is saying you need to,
Yeah.
at least start somewhere.
Start
Start
somewhere.
with something,
I think I like what you've just said, Nathan. It ties in very well with. So, are you saying I should put in, when I plan
Yeah.
on my budget,
Yeah,
I should consider that as well?
absolutely.
You start early. It goes back to the way you behave as a consumer.
Yes.
You come up with those good practices.
Absolutely.
Now, savings, the one you're talking about would be retirement, would be sort of a longer term one.
Yeah.
And then what if I want to save now I want to buy a new laptop, or
Yeah.
rather I want to buy a new cell phone? Because would you consider that, can I use that example for savings?
Yeah, absolutely. So it's a very broad topic, and
Yeah.
fortunately, we as consumers have a lot of options to invest in. Okay,
Yeah.
Different types of vehicles. So, and every vehicle has a different time period. So
Okay.
you'll have a short-term investment, which would be from a span of 1 to 3 years. You'll have your medium-term investment, which is like your endowment type of structured policies, where it's from 5 to 10 years onwards. And that's where, for instance, it's all really now about what your goal is.
And
So
choosing a vehicle.
So and choosing the viable vehicle as much as well as saying, okay, what is your risk appetite? So if you're a younger person, a young adult, it's advisable to go into more of a high risk type of investment. What I mean by high risk investment, I'm talking about investment potentially on the market, which is like an equity-based investment. So
your stock market, your
yeah,
stock
so
exchange.
something
Oh,
where
okay.
something where all right, you know what, this stock could go from R1 a share to R5 a share in the next year, okay, but it also could lose everything, So it's that high risk, game that you play. And then obviously for slightly older people, they can't afford to take that much risk,
much
because
risk,
there's not
yes,
much
yeah.
time that you can recover from your losses.
Yeah.
So, they always say, like, a rule of thumb when you invest in stocks is don't dump your stock as soon as it hits a bit of a low. Let it recover, and that's why you need time. So it's about understanding what risk you want to place on this money, what your intention is,
Yeah.
and how long you want to basically leave it in there. And that's how you'll pretty much look and choose the correct type of investment vehicle, should I say, that you can use.
Emotional people, that.
Yeah.
I'm looking at my money. There's my 100 rands. All of a sudden, it's
Yeah.
now 88 rands.
Yeah.
And the first thing I'd want to do is remove it. If I'm,
Yeah.
I'm investing long term,
Yes.
let me remove it, count my losses, and move. You're saying leave it there for a while because it's long term. You
Yeah.
need it for a long haul.
Yeah.
Oh, lovely. I like that.
100%.
All right.
100%. And, a lot of the time people, I mean, coming from a commerce background, studying accounting, time value of money was always embedded in my way of thinking. Okay.
Yes.
But what about the guys that are medical students, that are art students, that are, do they really understand the term time value of money?
No.
Time value of money is critical to us really understanding in how money can work for you,
Yeah.
making money work for you.
Yeah.
And a practical example would be, for instance, I've got 100,000 Rand right
Yeah.
now. Okay. I want to have R1 million in 10 years' time. Okay. However, I need to first understand what is R1 million going to be worth in 10 years'
In
time.
10 years'
Because it's
time.
not going to be the same R1 million now.
Yes.
Okay. So there's calculations, obviously, that one does. So you can be aware and say, okay, well, that R1 million in today's time will be maybe about 730,000. Okay. So when I'm working towards my goal, you need to utilize both those values, the R1 million and the 733,000,
And the inflation
to put into your calculation.
Yes.
And it just makes you understand exactly how you can be realistic in achieving your investment goals. So time value of money, it's a principle we talk a lot about extensively in our campaign, in our content hub, and it's essential for you to get to understand fully.
Start early, basically.
Yeah.
Oh, lovely. All right. The savings vehicles, like you said, you can go to the bank, isn't it?
Yeah. So there's
you
plenty.
can speak to a financial advisor who'll be able to tell you about different options.
Yeah.
Whether it's high risk, it's moderate risk,
Yes.
or low risk.
Yes.
And I
Yes.
guess depending on your life stage, if you're still in your, I calculated with 420s, in your
Yes.
first 20 and the second 20 before you become 40, and then
Yeah.
you know that those last 20
Yes, yes.
just before you retire, and then you have your 60 to 80 years, and that's where you don't want to invest a lot. You just want to be taking care of your money, or your money
Yes.
taking care of you.
Yes.
If I hear you properly, emphasizing that we should get to a point where the money works for us. Yes, you sweat at the beginning, but you get to a point where the money works for you.
Yeah. So now we come to the point of debt management. It's once again something that a lot of people are not. They don't want to talk about it. They want to hide it. It is a problem in South Africa. I think when we initially launched the campaign in 2019, our debt levels were at a certain. How can I say we're not good at all?
Yeah.
And obviously from COVID, they've been really inflated. So now we're sitting in 2021, and it's become more of, let's call it a crisis at the moment.
And people have lost their jobs. I mean, really.
Yeah, it's nothing that a lot of the time, and that's what people don't understand, is that when people get to being in debt, it's not something obviously that they planned for. There's been events and a lot of the time misfortune that's created this problem in their lives. Okay. And debt management is generally refers to the process of where basically somebody is over indebted. There's then a company that comes and says, well, we will reduce your current debt repayments to something that's affordable according to what your current lifestyle, what your current income is.
Yeah.
And then they create agreements with the relative creditors. Okay. But we're not really going to speak too much about that today. We're really going to talk about the positive sides of actually realistically managing your debt.
Yes.
So we're going to talk about it in another sense. So from a young adult's perspective, you've now newly employed, let's say. You're getting your first paycheck. There's money that's being deposited into your bank accounts. So you're creating a track of money. The banks obviously pick up on that, and they come and they offer you various facilities, credit cards. So what is important to understand about managing your debt really is about making sure that your credit score is well maintained. So before you do look at applying for credit, you do have a good score. So what I mean by a good score? Well, a good score is made up of a number of different factors. Okay, it's about basically how you've been managing your debt in the past. So whether it was a student account, a clothing account, that's a credit history that you've created now. Okay, so how you pay your account, you pay it on time, or you're a slow payer.
You pay in full?
Do you pay in full? And actually what's favorable is basically paying according to the agreement. So funny enough, when you pay something and you close it, it doesn't sometimes actually impact as well as it should, even though you've actually closed this debt. They want to see you honoring your credit agreement.
That's what they want to see. You've been
Yes.
paying on time,
Yes.
the correct amount.
Exactly.
Or the agreed amount.
100%. And what are the benefits of having a good score? Well, you get a better interest rate. So which obviously in turn then saves you on your installment.
Yeah.
Okay, it saves you down the line. I mean, a mighty load, especially with a long-term financing application like a home loan. If we're looking at a percent difference, it's
For
huge.
20 years,
It's massive. It's absolutely massive. I mean, people now are seeing that banks, obviously, with the repo rate being lowered to assist consumers in this time of need, people's bond repayments have been dropping a lot. So now people are seeing, gee whiz, if there's a 1% or 2% difference in the interest rate, my repayments are so much lower. So having said that, if I had applied for finance and I had a really good credit score, I would have even saved more. So we look at it from creating this culture in people to say, maintain your debt well, practice good behavior with your creditors, okay? And yes, there will be unfortunate circumstances where maybe you'll lose your job, whatever the case, and you cannot actually afford to be paying off this debt that you've initially taken out. There's processes that you can go about to avoid the worst case scenarios, for instance, where a company goes and puts a judgment against you, which basically then reflects on your credit report.
Would that a judgment would be now where the company has taken a legal action against my name?
Yes.
To inform other credit providers that this guy is a high risk payer. Either give him a high interest rate or minimize the amount of money that you can loan or credit out to him.
100%. That's exactly what it is. It's a signal to say this guy is a bad payer, and we need to notify you of that. But it doesn't obviously stop there. If you have borrowed money from an institution, you need to then pay it back. If you can't, they then come and attach. It's obviously a different level of exercises that they go through, but it can come to a stage of where they do attach your goods in lieu of the payment that is required, which is a nasty situation.
It's nasty.
But there are so many remedies to avoid a consumer getting into that position. As long as you inform your creditor about what your current lifestyle is, what your current circumstances are like, this is what you can afford. They generally have to accept what you put in place as an agreement. They have to give you that opportunity to say, this is what I can afford. Do you accept it? And 9 times out of 10, by law, they have to accept it. Instead of just running away and avoiding it and getting to that stage, correct it.
Have open negotiations.
Have open negotiations. Don't avoid calls. And then just keep a good relationship.
Nathan, what do? You get that 087 number and they call you a lot. Then the person on the other side was just trying to say, this is so and so, you're owing us. And we're living in, especially with the COVID-19 pandemic and the lockdowns, we're living in times where people are very depressed. You know? They don't know how to manage their debt. They are intending to do so, but there isn't much income coming through. I know it's risky, and we will talk about risk and how to avoid it as well. I hear what you're saying. It's difficult though sometimes to actually take those calls, to go to the bank. To some people it can be embarrassing as well.
No, it is, but I think to your point, so many people now with COVID are in those situations. It's not uncommon. Okay.
So you're not the only one. I think
you're not the only. You're not the only one. So take that initiative, and rather get it cleared up and have some understanding, but don't hide away. Hiding away is definitely the worst thing you can do. It doesn't give you the opportunity to defend yourself. Something that I've also really picked up, I'm sure you've also been experiencing this with people not understanding the real term of blacklisting. Okay. So blacklisting was something that doesn't actually really theoretically exist anymore as how it used to back in the days.
Back in the days, yes.
And what I mean by that, so back in the days with blacklisting, you would have somebody who, once they reach that point, really the chances of getting credit again in their life is like basically gone. It's zero. Okay. That's no longer part of how credits work. Okay. It's now really about that if you have got into a situation where you filed for sequestration, which yes is a topic all in itself, but and you've now declared yourself insolvent, you have an ability now to actually rehabilitate. And it's an exercise of 5 to 10 years. But once you do rehabilitate, you then have an option
You're good to go
get
back
credit
to
again.
the market again.
So it's not all doom and gloom, should I say? You know,
Right.
even if you don't get to the stages of sequestrating or declaring yourself insolvent, and you have all these all these debts that have kind of lined up, you can still make arrangements, sort them out, and your name can be back to how it was. You know, and it's important because I think so many people get so bogged down about that term. And my last point I'd also like to make about debt management is, let's just not look at debt in the bad sense. Let's also look at it in the good sense. Why do I say that? Because we need to distinguish that there's different types of debts. There is bad debt, but there's also good debt. What I mean by good debt?
Show me the difference, yeah.
So good debt pretty much is you're looking to purchase something that is an investment, that is something that is going to serve you for your future.
Yeah.
What do I mean? A house. So most people are going to take out a home loan in order to acquire a property over 20 years, live in this property, and pay, obviously, your bond repayment every month.
Good debt.
That's good debt. It's a positive debt. Your bad debt would really be taking out unnecessary store accounts, like clothing accounts. You know, do you really need that?
Just to impress.
Do you really need that? I mean, honestly speaking, if you're in a position to open an account, you obviously are, of course, earning an income.
Yeah.
So rather than say, you know what, I can't get that pair of shoes that I really like, those fancy shoes, I can get something for half the price, but then I don't have to take out credit to get those shoes.
Yes.
Rather look at that. That's bad debt. That's unnecessary debt. Okay.
So
taking out a credit card and for the sake of just going out and using it for entertainment and using it for this. And a credit card also can be used as good debt if you use it as a provision for when, for instance, there's a miscellaneous something that goes wrong and you need to access money. You have to have cash immediately. Then a credit card, or actually an overdraft, are those type of vehicles that can be used to save you in a bad situation. But yes, it's important that we do also approach debt in a good sense, because it can really help you. I mean, think about how major corporations started. They didn't just start with nothing. They had to go and they had a great idea. They had to go and get a business loan to build this great empire. That's good debt,
That's good debt, yeah.
So yeah, I think.
Thank you for that, Nathan. I
Fantastic.
think one thing that you're just bringing in now that I'll roll with, it's part of your risk as well. I'll tell you why. Risk is I'll explain it to you, is when you anticipate something that could go wrong, or risk is the management of that which could go wrong, which is the risk management portion. Things that could easily go wrong in our lives is, again, your credit card. You go into debt. I was just listening to you talking about how you can use your credit card to get out of certain situations. It's risky for a house to be leaking, because chances are you will ruin everything, which is the house content. There's an insurance product for that. We will talk about it. We will talk about the credit card itself being used properly as a good debt.
Yeah.
But at the same time, it can be risky that if you lose your job, what happens now, Nathan? You will be owing the bank a whole lot of money. Now, what usually happens is the banks would give you an extension of a product, which is called a value-added product, called a credit shortfall cover.
Yeah.
Earlier on, we were talking about risk, and I think we just wanted to define what risk is.
Yeah.
I think as human beings, we are always exposed to different types of risk. As we grow up, you were making an example about a young adult who's a school leaver, who's graduated.
Yeah.
Now they get their first salary. What usually happens is they start acquiring assets. Your clothing, the rental place, your household things like your appliances. There's always risk in that they might get lost through things like theft. I'm sure we're living in a country where we are exposed to people who are not employed. Chances are the place that you're staying at, it might not be necessarily safe. So there might be theft, there might be damage to your property. Damage does not necessarily come with cruel intention.
Yeah.
You might have a laptop, and when you shift, then it falls.
Yeah.
So that on its own, it's your risk in a sense that you risk losing that particular asset.
Right.
You risk losing your life.
Right.
You risk losing or damaging anything that you have. So I'm not going to go into the psychological portion of it or the technical aspect of risk, but one thing I would like you to know is how to manage your risk. Look, there are certain ways you can use, Nathan. Is first identify where the risk is or what are the possible risks.
Right.
You know, if I do not clean my gutters and they dry up, they can be a hazard to blockage and there'll be flooding. You know, if your geyser bursts, what are you gonna do? Do you leave your geyser underneath, above your ceiling or above the roof, or are you gonna place your geyser somewhere where if it was to burst, it won't actually flood your house? You know, so you start identifying all of those risks.
Sure.
And you analyze them and prioritize them accordingly. One of the ways of looking at the prioritization of risks is those that can cause too much harm. If I have a car and I don't maintain the car, what are the chances of the car breaking down? If I have a house and I do not maintain the house, either by cleanliness or even painting the surfaces, take your metal roof, you have to paint the metal roof.
Right.
Your butler doors, you have insurance companies saying you need to go into a place where your car is safe. Are you parking your car at a safe place? During the day, where do you park? At night, where do you park? So you start seeing where the risk is, and then now how do you mitigate it or how do you reduce your risk?
Okay.
So those
I like
are
that.
just the simple things that I want to talk to you about. Yeah.
No, I think you make a lot of sense, particularly as well now when we're looking at, this pandemic that we're in. People have now become a lot more, how can I say, aware of having a proper type of risk management plan or the impacts of why you should have a real risk management plan, because no one intended for such a pandemic to happen, right? But however, if you plan accordingly and you have the necessary and you understand the principles of risk management, you would have some type of a contingency plan that can obviously rescue you or give you some relief in this time of need, which, as we saw, not just from a South African perspective, from a global perspective,
from the whole world,
there was not that type of real appreciation of risk management. So in today's times now, people should really start focusing more on these type of principles that you've been going through, and really looking at minimizing and mitigating, your risk.
And there are many ways, Nathan, that you can use. Look, some of the things is just avoiding certain things. For argument's sake, if you are a mountain biker, the two risks: the asset that you have, which is an expensive mountain bike, and bodily injuries as well, where you can avoid it. Drag racing, you have a beautiful car which looks faster than my car. It's unnecessary to be a reckless driver on the road, because you're not only a hazard to yourself, but you're also a hazard to everybody else around you. Your house, do not neglect it. I'm sure every morning when we leave our house, we brush our teeth and we look a bit cleaner and neater. The same thing should happen with your house. So we encourage you to do things that will protect your properties. Your cell phone, especially with young adults, usually flash out the cell phone, but it doesn't have a cover, a screen cover. So those are some of the small practical examples that you can use to mitigate or minimize your risk.
No, 100%.
And talking about that, I think, Nathan, when it comes to minimizing of risk, get insurance as well. And I would like you to talk to us about insurance. Get insurance to cover those things, because the thing is, if you lose an asset, I'll give you an example. You have a car which is worth 200,000 rands. You're driving it around, you owe the bank now 180,000 rands.
Right.
But if that car is not insured and anything happens, whether it gets too damaged beyond repair, or it gets stolen, or by theft or fire, that total loss, you will still owe the bank the same amount of money that you were owing them before or after the loss. But if you have insurance, chances are you will be able to cover the total cost, or at least the bigger portion. And maybe, Nathan, talk to us about insurance as well, because now we've minimized the risk, we've identified the risks.
Yeah.
Now we want vehicles that will assist us in sort of navigate this difficult time of, not knowing when the loss is going to come, what's going to happen when the loss comes. How does insurance fit in? We spoke about banking and the financial sector, savings and investments and retirement and all of those. How does insurance fit in now with what we've just spoken about now?
Well, I think you've definitely kind of created a nice platform for me to introduce insurance into the topic. Exactly like what you're saying, if you've already now gone through your risk management exercise, you've identified where there's risks, you've mitigated accordingly, and now you're in a position to say, this is my asset register, be it for young adults, be it cell phones, be it their first vehicle, be it a house that they've maybe an apartment that they've just recently purchased. What are the necessary insurance covers that they should have in place according to their asset profile, really? So non-life insurance really is about now looking at your short-term insurance policies. And this is based, and it's really now an agreement between your insurer and yourself to pretty much protect your assets, okay, and pay a premium for that. That's what it pretty much in a nutshell is about. Okay.
Nathan, let me understand something. When you say non-life, okay, life insurance would be that which has to do with your whole body, your death, your disabilities, and all of that. That's life.
Yeah.
Non-life, life would be the long-term insurance, isn't it?
Yes.
Non-life, are you saying now? It's
Yes, you're quite right. No, you're 100% right.
Because we so used to it used to be short-term insurance. Is that right?
Yeah.
Oh,
so it is another term now commonly referred to.
Non-life. All right.
Non-life. So like I was mentioning, depending on your asset profile, there will be products, be it comprehensive type of structured policies that will work in tandem with your needs. Okay, so you have a number of different ways of how they categorize them. You have your motor insurance, you have your household or building insurance, and then you have your household contents and portable insurance. Okay, all risk covers. Okay. So essentially, when we look now at motor insurance, that's of course, like you mentioned an example, having your vehicle protected by a policy. So and having it preferably as a comprehensive type of cover, where you are now covered for your fire, your general type of things like fire, theft, third party. So what I mean by third party, if I have an accident on the road and I have a comprehensive insurance policy and I'm to blame for the accident, right? I now not only have to essentially cover my damaged vehicle, but I also have to now look at catering to the person's vehicle that I've damaged.
Oh, yes.
So there's effectively like a two claim scenario.
Yes.
So having a comprehensive insurance policy obviously will come in, you will kick in and assist you. And as well, once again, using your example, when you've financed the vehicle, it's important to always insure at retail value. What does retail value really mean? It's so that you can address the real need of insurance, which is to be placed in the position that you were in before the event. So you're not disadvantaged, you're not advantaged, you just put back. And having a policy like a comprehensive one that covers your retail value of your vehicle will mean that you will get basically back the same type of vehicle with the same type of characteristics when you do decide to replace it once your claim is approved. So
what happens if I finished paying my car? I don't owe the bank. I don't owe anybody. Most people do that. Yes, my last installment. Please cancel the insurance.
Yeah. So therefore, you put yourself at risk, because now if you have an accident and it's you at fault,
yes.
how do you now explain having to cover this person's vehicle? It's very difficult. And at the end of the day, your vehicle then, I mean, I don't like to refer to as your general vehicle as an asset. It normally is a liability because it depreciates in value.
Yeah.
But of course, when you have paid your car off, it
property.
is essentially, it is kind of an asset now, because you're utilizing it to
Yes.
to
Economic
execute
flow,
your work arrangements, to execute your daily activities. So it does then. So yes, you should have insurance, and yes, there are the relative type of policies that obviously cover that nowadays. So yes, the market is shifting towards covering all your different types of vehicles, whether it's paid off or not.
Yes.
And then moving on to building insurance. So if you own a home, the bank will generally instruct you to take out a policy to protect your home against
The home
flooding,
itself.
against lightning, against fire, against perils, basically.
Yeah.
Okay.
So would that be for the building itself?
For the building itself,
and the
the
walls
roof
around
and
it?
the internals, as far as the geysers are concerned.
Yes.
Basically, all the structures of the building that make it work.
Okay.
Okay. So naturally, if a bank is affording you credit and they're extending you a facility to take out a home loan, they want to know that their asset essentially as well is protected. So they will then say you must take out a necessary building insurance, which you actually as a consumer have the right to go and look in the market and choose the correct product that suits your needs, that suits your budget. And obviously, there's a broad range of different products out there, which a consumer has the ability to go and pick. So you don't have to just, by the way, elect what the bank tells you to.
So the bank
long
will
as you-
suggest,
Yeah.
or rather will recommend their
Yeah.
own product or the products they've used before.
Yes.
But you still
You have the
encouraging
option.
people to go out there and do
Yeah.
your quotations.
Exactly.
We usually say 3 quotations. It could be the bank that you're getting a loan from. It could be other 2 institutions. Just say I'm buying a house, or rather I've got this property, and then just
Yeah.
get to see what is it that they cover and see if you can afford.
Yeah, and look at, well, just like you're concerned, everyone's concerned in the premium, right?
Yeah.
Okay. But also look at the excess. What is the excess really on that insurance product? Sometimes it can be
What is
very,
an excess?
Well, yeah, basically an excess is...
That sounds like a very fancy word.
So an excess is essentially for the insurance to make a consumer aware that when you do claim, you will have to pay what they call an excess on approval of your claim.
Yeah.
So an excess is a once-off amount on the claim, per claim, that you pay upfront on claim approval. And it's just a way of managing their customers to say, guys, don't just always claim. You know what I mean?
All
Like
right, nice.
there is something that it's not just free for all. Let's claim.
In simple
It makes
terms,
you think about it.
Can I call it the self-insurance portion? Insurance will
Spot
give you
on.
the total amount, but in order for them to make you more responsible, because remember, insurance companies, you shake hands, you have agreements, you have your responsibilities and your rights, and they also have. So they're trying to discourage you from claiming too.
Yeah, and the higher, well, generally, if they're very happy with the way you've been, so if you're coming from a previous insurance policy, moving on to a new one, just like your credit score, they'll look at how you've managed that policy,
about that credit
and then
score.
they will also give you terms based on how you managed your insurance policies in the past. Are you somebody that's got a high loss ratio, someone that claims a lot? Are you not? They will give you preferential terms, obviously, if you've got a good track record. And going on to the excess portion, you'll have lower excesses, obviously.
You know what I like about this? You spoke to us about why it is necessary to take care of your credit score, because you get favorable terms with your financial institution. You're coming back to insurance again, and you're saying they also look at that. It's almost like your credit score.
Yeah.
You've behaved according to the agreement.
Yes.
And therefore you are at a favorable point with them in terms of the premiums, the excess, but if you sort of misbehave, just like you said with the interest rate might be higher. This time it will be your excess might be higher because the insurance is this is a delinquent.
And something else, when you do apply for insurance, they'll also do a credit check as well on top of that. So they will utilize a number of different indicators for them to best risk rate your product that you're looking to acquire with.
The rating of risk.
So yeah, so they will look at a number of different factors. But going back now to the building insurance, obviously it doesn't make sense that you're paying all this money towards your bond. It's your home, it's your future, and you don't have the necessary covers in place for one of these, like I was saying, a peril, natural disaster, perils, the risks that are involved with managing a property. It's a small portion, obviously, of what you pay towards the bank for your home loan, so it only makes sense to have a good comprehensive product for your building, your home. And then you have your household content insurance, which is actually covering the contents within the building. So your TVs, your fridge, all your contents that you have. So that's covering it against the main type of events are, theft, fire, damage. So now there's actually products out there that will cover if you damage one of your appliances. So let's say you've got a 3-year-old and she decides to throw something at the TV because she thinks it's cause and effect, and the TV crashes down on the floor. There are actually products now out in the market that will cover such events.
Such an event.
So, which is great. So getting now to the cell phone, that's the all risk cover. So that's now covering your portable possession. So portable possession being a cell phone, laptop, and actually giving you cover from the second you walk out of your property, and covering that particular portable possession. So if it gets lost, it gets stolen, yes. So that's now your all risk covers.
Okay.
So those are the three main elements of insurance that we all should be looking at: is your motor insurance, your house, your home insurance, your household content insurance, and then of course your all risk. So 4 in all actually is the ones that you should be focusing on and really looking and seeing, am I correctly covered? Do I have the right type of structured policy that will work for me?
Okay.
So that's pretty much now. I think we've comfortably wrapped up the topic of non-life insurance. And if we look at now the couple of terms, I think.
I was about to say, Nathan, when we speak insurance, there's always these jargon, these major terms that are used, and sometimes I'll be honest with you, they remove people away from wanting to inquire because they are scared they might ask wrong questions. Tell us some of the terms that we use in insurance. I can go ahead and mention something like excess, which you've explained.
Yes.
What policyholder, those words can be pretty confusing. I'm honest with you.
Yeah, no. So I mean, the general type of terms that you'll always see on every policy is you'll see insurance ombudsman. So that is a regulating body that really goes and assists consumers in line with the Consumer Protection Act.
Okay.
In the event of where a consumer feels they were hard done by. So let's say, for instance, a claim was repudiated, so a claim was rejected for whatever reason. A consumer still has the opportunity to now go and approach the ombudsman to say, this is a scenario, I have this policy with this company, please can you have a look at it from almost like a third-party perspective, and advise on if
like
their decision is
of some
100%. It's exactly that in the insurance space. So it does give consumers that level of protection, because there's always this general consensus about insurers that they don't want to pay or this and that, but you know what? It's really now about being fair. It's about having an environment with it's all about applying that principle of treating customers fairly, and what better than having an actual regulating body that has no interest in an insurance company, that's not necessarily going to be completely on your team, but they're going to come, like I said, as a mediator and look and see and put the facts and figures together, see were they right, were they wrong. Okay.
That's an insurance ombuds.
Yeah. So I mean that's really looking at the terms, like I said, repudiation. We've discussed excess.
Repudiation would be when they deny, when they reject your claim.
Yeah. Yeah.
A policy holder would be a person who goes, that's me, going
Yeah.
to the insurance company, isn't it?
Yeah, yeah.
So maybe let's just simplify it for them. Is there's an insurance company which we call the insurer,
Yeah.
and then there's you who becomes the policyholder, meaning
Yes.
the insured.
Yes,
Now
correct.
both of you come in, shake hands, and say we agree to take care of this item when such an event occurs.
Yes, yes.
When that event occurs, you go back to the insurer and say the event has occurred, which is a claim now.
Yes,
You
yes.
lay a claim. They look at what do you call this thing that you say? They look at the legalities or
Yeah, like the whole scenario.
yeah, and then that's when they settle you back. You spoke about something about put you back to where you were before.
Yes, yes. That's the whole idea, essentially. I mean, that's what it's really
Okay.
about. So,
And let me tell you about insurance as well. It's a whole lot of people who come in. We put money into one basket. So if one of us gets a loss, we take from that amount of money, we replace. We take that money. So the more all of us claim at the same time, the more the kitty will be empty. Which is why it is very important to be responsible, to minimize all the things that could cause harm to both your property and yourself as well. And remember, there are agreements as well. That's where you'll find your policy wording, your policy schedule, which we always encourage you to look at. But if you fail and you don't understand some of these things, you can go to organizations like South African Insurance Association.
yeah.
Who are they, by the way?
So they're an organization that's been established to really assist consumers and really like as almost an information hub where consumers have the ability to know what their rights are within the insurance space. Okay.
Even to hold the insurance accountable, maybe as well.
Yeah. Essentially, it's basic. I don't want to put them in the same capacity as an ombuds, because they're not going to come and represent you like an ombuds would. It's actually really about just, if you look at the whole, it's exactly what I'm saying. It's an information type of hub where consumers can go and source the necessary information so that they know that they have peace of mind when taking out an insurance policy. There are these different type of bodies that are around to encourage consumers to say, you're not alone.
Yeah.
There's enough information going around to say, you can make an informed decision. And it's not just a case of a product being shoved down your throat,
Yeah. And I was looking at the other article, an article the other day where they said, always engage with a reputable insurance company. Just make sure that they are registered. They have an FSP license, financial services provider license. I think it's the financial FSCA.
Yeah.
They are a body which will actually look at or register all the insurance companies. If an insurance company is not in the FSCA's list, register, you worry about them. So I see how it fits in. So all these other bodies, and I'm sure even insurance companies themselves, they have the complaints department where you can go to.
Yes, they have the internal department. No, yes, 100%. The ombudsman is the last resort. And I mean, for instance, South African Insurance Association actually has, once again, like you mentioned now with FSCA having
the Financial Sector Conduct Authority,
registered providers under them. The same goes for SAIA, where they've got the providers, your different type of companies that give you these insurance policies that fall under SAIA and actually contribute towards the initiative in driving the promotion of insurance literacy.
Is this why we're here now?
Yeah, there we go. I mean, we've just pretty much,
Thank you. Nathan, I think it was very informative for me today.
Same, yeah.
Thank you for sharing the platform. And I'm sure most of us have learned a lot.
Thanks for tuning in. Thanks for joining us for this wonderful session. It's been a great pleasure.
I hope it
Mr.
was very
Motiva.
informing. Thank you so much, Mr. Hellman.
And you guys have a great day further.